That is I mean, it's a quick highlight. If you read through the paper, we're labeling this risk parity, right? But if you read through the paper, we've labeled each one of those methods different things, right? Hierarchical subspace, max diversification, ERC. This just goes to show when people go online and rail against a fund that did poorly, and they say, look, risk parity's done so bad in the last quarter. Reality is that you'll find another one that's done really well, right? So there's different methods, and the key here is not, like Adam said, not to look at and choose the best back test. That is the problem that every quant gets into, but really understand and try to maximize your understanding of the dynamics in markets and create a risk parity portfolio that might not have the best practice, but from a fundamental perspective, from a true understanding of the dynamics, will provide the greatest balance going forward, right? First principles and so on. So that's a beta. Also, let's go back up to risk parity, and we're talking about risk parity with that assumption that it's that every asset class has the same Sharpe ratio. That is something that was popularized by AQR, by Panagora, by maybe not so much Bridgewater, but I guess Bridgewater as well. What other beta concepts could be just as good, assuming that we're living in the same universe, that we're including commodities, that we're including equities, that we're including bonds, and so on? We certainly have a view on that. So, let's talk about alternative betas here from the context of a multi-asset balanced portfolio.
Yeah.
Right. So carry is one of them, right?
There's the mathematical side of it, right? So you have a series of mathematical calculations that you can make based on what? Well, some assumptions. Well, what are the assumptions that you might be making? Is it the true risk parity assumption that volatility is directly related to a return? Mm-hmm. Or is it like you mentioned, Rod, and I'll throw it back over to Adam, carry or the yield on a particular area? How might that inform the portfolio? And are there others?
Yeah, great question. And just for disclosure, we combine our global risk parity portfolio with a carry strategy tilt, and we're going to get into why that is. But I mean, risk parity assumes that at all times first of all, broad global asset classes are priced to deliver a return in excess of cash. Okay. Capitalism is operating appropriately, and so investors should expect to earn a premium for taking more risk. And it assumes that returns are in proportion to volatility. Volatility is a measure of risk. Returns are proportional risk, and so returns are proportional to volatility. But are there other ways that we might be able to proxy risk? Well, I think one of the ways that you might be able to proxy risk is the yield on a security. So, for example, a longer duration bond typically in a normal environment has a higher return, a higher premium or yield than a lower duration bond. And that's because investors that invest in this longer duration bond have to endure higher price variability because of its longer duration, and are more vulnerable to changes in inflation expectations and real rates over time. You could say the same thing with equities. Higher yielding equities are reflecting a higher risk of the vulnerability or variability of cash flows, a higher risk that a company may or may not pay dividends, et cetera. And so you go through these. The other thing is that, you don't always have an environment that's normal. So this year is a great example. We had, in some cases, major inversions of the yield curve where cash rates were higher than rates that were further out along the curve. And in fact, you had a higher expected return from cash than you did from taking duration risk. So that violates the basic assumptions of risk parity. So what I like about this global carry strategy is it says we've got the same diversity in terms of our universe. We're investing across all these global asset classes that are fundamentally designed to do well in different economic environments. We are accounting for their different levels of ambient risk. So we're making sure to hold them in balance. But if a market is priced to deliver negative excess returns, for example, if the yield curve is inverted or the dividend yield, the implied dividend yield on an equity market falls well below cash rates, or a commodity market goes deep into contango, then we probably don't want to hold that market long. We may even want to hold that market short because we're going to harvest the yield on that market from going short rather than being long, right? So, it's diversifying across different frameworks. Risk and return, risk parity says risk and return is connected by volatility. Global carry says risk and return is connected by yield. And we're still delivering the same principles of diversity and balance, but with different frameworks for the relationships between risk and return. And the great thing about this is that, at least empirically, and I think for strong fundamental reasons, a global carry strategy that invests across global equity markets, global bond markets, global commodities, has a very low correlation to a traditional risk parity portfolio. So you get this diversified beta portfolio and another diversified beta portfolio, equally resilient to different types of economic shocks, and coming together to deliver a whole portfolio that is substantially better than the sum of its parts.